The paper deals with structured products for retail investors. So I approached the topic with an analysis of the market, the players, and the products themselves. And during the course of that examination, I found an interesting paradox that I could not find an answer to. So consequently, I decided to find an empirical answer for that myself and put it in the spotlight of the paper. Therefore, I undertook a survey among the buy side and I conducted an interview with the sell side. After that, I interpreted those empirical results in the light of the theory and tried to explain the paradox. Now that's the idea of the paper. And the way I'm going to present this content to you is as follows. I will start with the products. I will show you how initially the need for structured products arose, which characteristics define them, and how the underlying option mechanics work. Putting this together, we will see that retail structured products, or RSPs, enhance the possibilities of investing for private investors. And then I will provide an overview of the market and the industry. We will see that trust issues arose after the crash of 2008 and that market volume for retail structured products stagnated. This goes in line with current estimations that only a smaller percentage of retail investors holds this asset in their portfolio. And here we have that paradox. These are diametrically opposing facts. And there is a question as to why retail investors are now reluctant to invest in structured products. The key to this question lies in the empirical part. I will test on the existing common stereotypes against RSPs that describe the reluctance in a superficial manner. However, it will also go beyond that in order to provide a more detailed picture. I will explain the methodological approach as to conducting both a survey among retail investors and an interview with an expert in RSPs. The importance to use different test groups, and finally, all the results and findings in detail. Based on all of that, I will then answer the thesis question in a differentiated way and wrap it up. So without further ado, let's dive right into the products and see how there was a need for them in the first place. The investment universe of a private investor in the 1980s contained financial instruments like stocks, bonds, funds, and the money market. There was no possibility to trade option contracts because of two problems. First, no access. Private investors did not meet the requirements to participate in the future markets. And second, they were too risky. Short positions in option contracts face the possibility of unlimited losses. Therefore, they're not suitable for retail investing. As a result, the investment universe limited them to simple investment strategies. In the 90s, investment banks sensed the demand among well-informed and self-determined retail investors for more complex investment strategies that included option payoffs. And the result of their development were structured products. The idea is to glue an option together with the underlying and securitize that portfolio in a single strategic payoff profile, overcoming those previous issues. Let's look at the three major products of the German market. Here the names are really more like a marketing thing, and so is the German typical expression certificates, by the way. Now, behind the name of a discount, there is the covered call writing strategy. The idea is to earn an option premium by capping the payoff of the underlying. And this is achieved with a portfolio of a short position in the call and a long position in the underlying. From that composition, we see that the net vega is short, so the investor should buy this portfolio when volatility is high and the option premium is high as well. Then there is the reverse convertible, where the idea is the same and so is the composition of the hedging. The difference is really just the distribution of the payoff, which has some characteristics similar to a bond, like a coupon. But under normal market condition, their value is the same as a discount certificate. Last but not least, we have the bonus structure. The idea is to provide a cushion for moderate losses in the underlying. The issuer therefore attaches a down and out put option to the underlying. As the down and out put option is a barrier option, it offers only a partial protection for losses. That is, only up until the barrier does not get undercut. And this characteristics makes this option component comparably cheap to buy. Oftentimes, the dividend payments of the underlying suffice to finance that option. And if not, for example, with a commodity as an underlying, the option premium is just reflected in the pricing of the structure. So, these three structures are not only the most successful ones in the category of investment products, they are also the most simplistic products. And quantitative research has shown that these simple structures can indeed achieve risk-free excess returns of up to 35 basis points per year. All is good. So now we saw where RSPs came from and we saw how they worked. What's missing is a definition and a takeaway. Definition: RSPs are financial investment vehicles with derivative components. Up to there, all of the above led to the fact that they can well add value to a retail investor's portfolio. Unfortunately, this was not the end of the story. The turning point is in the mid-2000s when things started going bad. Banks issued highly complex structures including multiple asset baskets as underlyings, multiple barriers, and multiple observation dates. These characteristics made the products so intransparent that the average retail investor had no chance to understand them, meaning there was no realistic way to assess the risks of the investment. Also, they were also unattractive in terms of risk-adjusted return. Then there was the default of Lehman Brothers, and many private investors had to learn in a painful way that structured products are no fund assets, so they become a worthless claim if the issuer goes bust. The whole asset class became a source of disappointment and was left with a bad reputation. Since the crash, the demand for the intransparent, highly complex structures practically disappeared, and so did the products. You see that this fades into the markets part, and we will now do the handoff. The top player in this market is Deutsche Bank, followed by Commerzbank and Helaba. The most turnover is generated with knockout structures, and we see that the vast majority of products is based on stocks. Now, as promised, we will look at what happened to the market volume of German retail derivatives. Here we see the size of the market over the last 10 years. Most obvious is the massive decrease in volume during the crash of 2008. We now compare this to the German stock market, namely the DAX index, which is realistic since this is a performance index. We see that both paths are highly correlated, almost congruent until 2008. Then they start to drift apart. While the stock market reaches new peaks in 2013, the market volume for RSPs makes no substantial pullback after the crash. If the stock prices rise and the main underlying are German stocks in a long position, the volume of retail derivatives would naturally rise as well, just as it did before 2008. However, this wasn't the case, and there remains some delta. This can only be explained by net cash outflows of the market. A survey, which was conducted by the branch association Deutscher Derivateverband, DDV, in 2014, confirms that most private investors regard a share of less than 20% in retail structured products as best for a private portfolio. We can pin this down to a lower interest and lower perceived attractiveness. So here we are at the point to raise the question. If the arguments of the new possibilities and performance benefits were true, why did retail investors become reluctant to invest in RSPs? Okay, what's granted is that the Lehman event diminished trust and that the intransparency of bad, complex structures affected the general reputation. And that's why common stereotypes against RSPs are complexity and intransparency. But there is more to it than just the stereotypes, which we will discover now in the empirical part. I want to start off with a few words on the methodological conception. And this slide is interesting because it shows the two-step process of my empirical inquiry, and here's why I did that. First, I conducted an online survey among retail investors and analyzed their results. In a second step, I went to an expert from the field of RSPs from Deutsche Bank and interviewed him with regard to the results of that survey. This had two intentions. The interview was supposed to be a verifying element to the survey, meaning it should countercheck if those answers reflect approximately what the professional is experiencing in his daily work with private investors. And even more important, it should complete the picture with an empirical input from the sell side as well. Now, within the survey, the idea was to categorize the participants into three groups with different levels of expertise in financial instruments. There was a universal first set of questions just for this purpose. Then the survey split the respondents, and each group had to answer different second sets of questions. Those then asked the questions that were technically relevant for each group. The total test group contained of 53 respondents who were mostly young men who considered themselves as risk-averse, and the split was almost equally. The first group had no experience in financial instruments at all, while the second group of respondents has exclusively invested in traditional assets like stocks, bonds, and funds. The third group has also traded RSPs before. And only that way I was able to determine what groups were of which opinions. And more importantly, this allowed me in the end to filter out opinions that logically cannot have any explanatory power to the reluctance to invest. So that's all there is to that. Let's look at the responses. First, those of the non-investors. A straightforward question as to why they never invested in financial assets revealed that no interest and no money to invest, as well as general risk adversity, are among the top reasons for non-investors to stay away from capital markets. Now, asked for their preferred instruments for a potential future investment, a majority of nearly 90% was more appealed by traditional assets. Then, to assess the conceivability of these non-investors, they should estimate the initial capital requirements to just start trading on the one hand and to trade successfully on the other hand. What exactly successful trading means was not further specified in order not to overstrain these non-investors. The important finding from the answer is that the participants indeed distinguished between the two and showed a tendency to connect successful trading to higher capital requirements. And this showed a sense for the principle of transaction costs, because they typically decrease in relation to the traded asset when the trading volume is increased. Also, the overall range of estimations is quite appropriate, as it was later confirmed by the expert. So, as a takeaway, we can say that the participants of the survey who never had financial instruments before showed a basic understanding of market mechanics. And we will pick up on these points later again for the bigger picture of the analysis part. Now, we will look at the group of traditional investors, and we remember that their relevant sets of questions was different. Their motivation to avoid retail derivatives is mostly a lack of money to invest in this asset class, the high broker costs associated with a high turnover of derivatives positions, and the lack of technical knowledge on this matter. These answers are based on multiple choice answers. However, the respondents could also name their main hurdles in an open-ended question. And here are just two of them. I could find out more about the product, but if I'm already struggling to understand what the product is, I think I better stay with stocks. And another one, pseudo-complexity. That means deliberately illustrating products more complex than they actually are. And I thought this was very interesting, and that it could refer to the fact that those product illustrations usually don't let the components of the products speak for themselves. What is also interesting to get to know from this group is how big of an issue the assumptions of the typical stereotypes really are. The test group was asked if they were afraid of the intransparency or complexity of RSPs. And from those results, you can see that intransparency and complexity are indeed restraining this group from investments in derivatives. However, it cannot be said that every investor who avoids derivatives does so because of complexity and intransparency. As a result of this matter, a faithful selection of product requires time, which is also stated as a hurdle. Apparently, these respondents think that the selection process is quite time-consuming. The rough average is like half an hour. So, we note that the stereotypes of complexity and intransparency do not apply to most traditional investors, and that their unwillingness to spend time that is necessary to obtain all the product information is present. And here's the last test group, namely the RSP investors, whose results are even more exploitable to answer the question. The participants were asked the now following questions with respect to their preferred structure, which provided some structure-specific inputs to the survey. And for that, it is important to know that about 2/3 traded foremost leveraged products. So, for the later analysis, the attitude of this group towards stereotypes was examined as well. Given their expertise, it was more detailed. Regarding transparency, 87% stated that transparent payout profiles are critical. However, only 56% thought that products they preferably buy have in fact transparent payout profiles. And regarding complexity, most participants regarded leveraged structures as the most complex ones and discount structures as the least complex ones. Surprisingly, just a little over one half typically understands the structure they are about to buy. And this is really interesting. A majority of 69% decides to trade the, in their opinion, most complex structures. Also, a delta of 31% between the two answers in the transparency section decides to buy products which they don't really understand what they may receive, although those same exact respondents have stated that this is critical before. And almost half of them buys product without a full understanding of the structure. Okay, now after we collected all the data for the analysis part, there were some bonus questions to this test group, and I want to show some answers that put complexity into perspective with performance of different products. So, as a qualitative measure for absolute performance, I used overall satisfaction and willingness to recommend RSPs to befriend. And we see that those answers are mostly positive. Although recommending something risky to a friend was a little less pleasing to participants. So that is absolute performance, and here we will contrast performance to complexity among asset classes. Because this is quite some data, I'm going to say right where to look at. So the combination of all bars on the top states that investors typically wish to spend more time on product selection than they actually do. Also, the three biggest bars labeled with 8, 9, and 11 indicate that RSPs and traditional assets require rather more time, while vanilla options require not as much. The lower donuts indicate that traditional assets do on average match RSPs in terms of subjectively perceived performance, while plain vanillas tend to perform better than RSPs on average. And this is highly plausible from a theoretical standpoint, since RSPs include a higher margin due to the structuring costs of the bank. In fact, one question dealt with margins in RSPs, and the expert confirmed that the respondents had a pretty good idea on marketing practices as well. Margining would lead too far at this point, but the expert opinions is now the right link to go to the interview part, which is concentrated on the next slide. This was a 20-minute interview that we had right next to Deutsche Bank's trading floor in Frankfurt, and I will now present 6 highlights. As mentioned, the interview should classify also the answers of the test groups to some extent. And as it turned out, their guesses of RSP investors on margining and those of non-investors on capital requirements were quite precise. Asked for the client's hurdles to invest in retail structured products, the experts said that they often have fundamental comprehension problems of financial markets. And since, for example, the price formation of a derivative is even more advanced, that complexity of derivatives is an issue. And the general fear of losing money affects the RSP industry as well. We also talked about the portfolio share, which was one of the initial springboards. A serious trader who conceives the dynamics of the products may well replace a lot of stocks with the appropriate structures. Some structures, however, require intensive monitoring and do not suit every investor. On recent trends, the expert could confirm that the demand for simple structures keeps continuing in general, and that the factor structures and reverse convertibles are having an upswing. So, let's look at them in more detail. Regarding reverse convertibles, I wanted to know what justified their strong standing, given that they are technically no better than the simpler discount structure. And the answer pointed out that marketing focused on the bond-like characteristics in order to appeal former retail bond investors. Then, the factor certificates are simple because their pricing is perfectly traceable. It's just underlyings times the factor for the investor. But behind the scenes, it's mathematically complex delevering and relevering on a continuous basis, which then has the effect of a lower knockout risk compared to other leverage structures. All right, now we have an overview of all the data collected. Let's analyze to finally answer the question. First, it can be said that there are different reasons to explain the reluctance of retail investors, and that these reasons do not show the same level of significance for each test group. And because we anticipated that, we did the split up. So, both non-investors and traditional investors explain why RSPs play a niche role only through their bare presence. But the non-investors are not interested in financial markets, and even if they would be first interested in traditional investments, that places them completely outside of the RSP universe. Traditional investors typically avoid RSPs due to their complexity and intransparency. I suggest that there may be a causal nexus between them. See, if investors took the time to figure out the product's mechanics once, they would get a better understanding of the products. If they had a good understanding of the products, they could select a product that fits their risk profile and their market expectation in a short time. And as a final result of understanding the mechanics, they would not be as reluctant to invest in RSPs. All right, now the RSP investors. The participants of the survey mainly traded leveraged products, classifying them as not explicitly shy of risk. What they care about is return, since 89% regard the payout profile as critical. On the other hand, a complete understanding is only secondary, documented by the fact that 44% buy products that they do not entirely understand. And this eliminates the question about stereotypes, because these do not apply to the group of RSP investors. That's the analysis of the groups of retail investors and the reasons for their reluctance. And this is a result that suggests that the market stagnation had other reasons. Potentially, some RSP investors simply quit their trading after default experiences connected with the Lehman event, or lowered their share in derivative products after dramatic losses in 2008. This is what I call aggregated analysis because it puts everything together. Big hurdle of the products are their complexity. But at the same time, this complexity is a result of the natural product design, because options, in some cases barrier options as well, are complex to price, and every issuer needs to offer tens of thousands of products in order to offer this one product that fits the client's exact market expectation. That complexity makes them per se not adequate for the typical retail investor, the average Joe. And if the average retail investor holds a complex structures, then the chances are high that he did not buy it from an intrinsic motivation. Especially before crisis, the sales agents in the bank's branch office had pulled average Joe into the group of RSP investors, and by now we know the rest of the story. And this explained a reduced number of RSP investors after the crisis, namely on the ground of not genuine RSP investors moving back to the investor group where they actually belong. That's the main thing, but there are some additions to make. The discount certificate may be the best product. The idea is basic and the structure is simple, as the survey has shown. Academic research showed that it performs among the best of its peer, which could also explain why the industry showcases particularly this product type for performance evaluation. Also, the perception of product costs is higher when the costs are directly visible. That goes back to the survey, where respondents first and foremost stated directly visible costs, such as the bid-ask spread over other sources of margin. Next, RSP investors prove to have an accurate product knowledge, which was based on questions regarding product mechanics. Next, RSP investors prove to have an accurate product knowledge, which was based on questions regarding product mechanics. And finally, my suggestion to make after this analysis would be to change the way products are marketed. Instead of fancy product names and lots of if clauses to explain them, the focus should clearly be on the composition. This would give the informed investor a quicker understanding and would have a warning effect on the average retail investor. It's now time to conclude. The empirical data showed that common stereotypes are not significant enough to explain the stagnation in market volume. The reasons for that are others expected to be in the field of developments around the Lehman event. But the common stereotypes can well explain the comparably low share in retail portfolios, and that's because they do apply to non-investors and traditional investors. RSPs are best suited for self-determined private investors who watch the market as if it was a sport for them, because they figure out the option mechanics and can assess the risks of the products fairly good. And it is predetermined that by design of the retail structured products, that the average retail investor without a good advisor would not be satisfied with them in the long term, because it is only a matter of time until the unexplainable losses will cause frustration. As an outlook, we can see that a few brokers start to offer margin account-like systems for retail derivatives to overcome their shortcoming of issuer default risk. And we'll see if that establishes. Also, we can observe that exchange-traded products are becoming more and more innovative and that they can already replicate many derivative strategies without the counterparty risk at a lower cost. What remains to be seen is if those innovations will increase the momentum of the private investors' reluctance to invest in RSPs. Thank you very much.